Now, let me start off by saying I'm not a mortgage lender, and you should speak to your lender to learn about different options in mortgages. But I can give you a general idea of some of the terms you may hear in that conversation and things to start thinking about. Two terms you may hear are adjustable rate and fixed rate when it comes to different kinds of mortgages. Adjustable rate mortgages and fixed rate mortgages are opposites, and they each have pros and cons associated with them. Basically, a fixed rate mortgage is when you lock in an interest rate when you acquire the loan. That interest rate is the rate you pay on for the life of the loan, unless of course you choose to refinance at some point. While the ratio of principal versus interest rate changes, your overall payment each month remains the same. This makes it an easy mortgage to budget with, and you don't get any sudden surprises. When you are talking with your mortgage lender, ask them for an amortization schedule and check out my video about amortization. It's basically your payoff schedule for the loan. The downside is that you may end up locking in an interest rate that is higher than what interest rates become in the future. Also, qualifying for a mortgage when interest rates are higher can be harder. An adjustable rate mortgage features an interest rate that begins below the market rate, but after a set amount of time, changes over the life of the loan, mostly upward, at a prearranged frequency. The time period that it remains at the initial low interest rate varies depending on the loan, anywhere from 1 month to 10 years. If the mortgage is held for long enough, you could end up passing the current market rates and paying even more than you would have paid if you had gone with a fixed rate mortgage. So which one do you go with? Well, first you need to determine how long you plan to live in the home and pay on that mortgage. If you plan to only be in that home for a couple years to build some equity and then move on, an adjustable rate mortgage could save you the most money. If you plan to stay in the home more long term, likely a fixed rate mortgage is a better deal for you. Your mortgage lender will be able to tell you which one makes more sense for you based on your plans and your financial situation. I work with some great mortgage lenders in Lynn and Lane counties, and I would be happy to refer you to a great one who can walk you through the mortgage process and make sure you have the best setup possible for your needs. Thank you so much for watching this video, and be sure to check out my other real estate videos to learn everything you need to know about buying and selling real estate in Oregon.